Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And boy, do I have a special treat for you. In case you haven't noticed, my background's a bit different. That's because I'm actually in downtown Toronto in the Global X Canada headquarters on University Street. Pretty cool meeting everyone here. And I got a special treat for you because I'm about to sit down face to face with Chris McKinney, who's head of investments here at Global X Canada. And I'm going to be grilling him. I'm going to be asking him a bunch of questions, specifically on the recent volatility, how it impacts covered call ETFs. Are our distributions safe? When do they decide to maybe cut them? How do they evaluate that? So I've been getting a crap load of questions from you guys that are worried about your distributions, worried about your dividends, and is there a reduction coming now that the NAVs have dropped 15, 20%? But then again, we know that volatility helps cover call premium. So these are all the questions I'm going to be asking Chris, so stay tuned. So Chris, thanks again for joining us here on the channel, back again. Thanks for taking the time. How you been?
Been good. In person this time, so it's a little bit different, but excited for it.
Yeah, same here. It's fun. First in person, or better than Zoom, I would say, or different. So, there's been a lot of volatility in the market lately. We'll get into it right away because volatility has a direct link with covered calls, covered call premiums, covered call ETFs, right, which is what my channel focuses on. So let's get in it right away. So how does volatility impact covered call premiums? We know that covered call premiums are bigger during volatility, and you guys are really an active ETF manager, right? An active manager also when it comes to those covered calls. So how are you guys taking advantage of this spike in volatility?
That's right. Yeah, and it is, important to be active in terms of the implementation piece, at least on these option overlays, specifically in volatile environments like we have right now. Being able to be patient, wait a day or potentially two to get into a trade, or even legging into a trade over time. We think that's very important, particularly in these times when prices move up and down so quickly. As you say, premiums tend to be very outsized during these times, and so we, as covered call managers, we want to make sure we're taking advantage of that. So we are quite active at this time, but it is about being patient, being careful in the implementation piece specifically.
Okay, you said legging into a trade. Maybe for some of us who are not as technical, you could explain what that means when it comes to the covered calls.
Sure. Say I have a trade and I want to sell 100 option contracts, for example. Typically I could do that on a third Friday and not have to worry about it. But when volatility is very high, maybe I spread that out over a couple of days and I only do 50 today and then 50 again tomorrow, because we don't know what tomorrow brings. Spreading out that trade over time, diversifies when you're getting into that trade, and so it can just help smooth out some of that volatility.
Okay, so it has to do with like the options, the expiration. So you're actually diversifying the actual call options as well.
That's right. Yeah,
that's really cool.
Yeah.
Okay, so I'm very curious about this, and I always wanted to ask someone who's very technical because I never wrote an option in my life. We know that the VIX measures the volatility of the S&P 500, and for anyone watching, you could just Google VIX or VIX ETF and you'll see that chart, like a regular stock chart. So when we say that, increased volatility or increased VIX gives you much higher premiums, how much are we talking about? So for example, if VIX is 15 and then it goes to 30, if you're writing another call option on that same asset, is it literally like double the premium, or how does that work?
Yeah, it's a good question. And, obviously there's different variables that go into the option pricing formula, but by and large, that volatility component is the biggest driver of an options price. So, when volatility is around 15, and I'll give some rule of thumb numbers or some sort of back of the envelope. We have a chart as well that we can put up that kind of describes this. When vol's around 15, you can write an at-the-money option on S&P for 30 days and get about 1.8% for that 30 days. When vol goes up to 20, that becomes about a 2.4% yield you can generate. And when it gets up to 25, then that is about 3%. So it does elevate quickly as volatility moves up. And of course, we've seen vol in the 30s and 40s recently. And so the premium does kind of scale up with that. Now, the other thing to keep in mind is pricing in the markets also tends to widen out a little bit. So, when you trade, there is a quote unquote cost to that trade. So you have to be careful when volatility is high, but you can certainly see, the type of premiums you can generate in this market.
Okay, so you said that's the most important factor, and that's what I've heard from many people. But there is another factor. It has to do with stock prices, NAVs, and correct me if I'm wrong here. This is where I'm really out of my element. But yes, when volatility is higher, you'll take in more premiums. But let's say there's a big drop in the market like we recently had, 15, 20%. In a matter of days or a week or whatnot, that means technically the stock prices go down 20%. I'll stick with 20% as an example. How does the decline in stock prices impact the premiums? I'm assuming that will have a negative effect, I'm assuming here, but the VIX going up or the volatility going up will have a positive impact. Maybe you could talk a little bit about that.
Yeah, that's a good question, because last question we talked about in percentage terms,
yes,
right? And so obviously 1% of 100 is different than 1% of 90 or 80 if there's a 20% sell-off. What we see is typically when the market is selling off, that increase in volatility tends to more than compensate for that reduction in terms of that net asset value. So again, if stocks are down 20%, you're not getting that only 1.8% because chances are volatility is very, very elevated there. And so the actual net dollars you're collecting is higher as well, not just in percentage terms, but the actual dollars you're collecting tends to be higher as well.
Okay, you said something super interesting and something that makes me really happy, that it more or less compensates. So what would be a point, for example, where it wouldn't compensate? Are we talking like 30, 40% drop? But in that case, volatility would probably spike even higher. So I'm not sure if I'm asking my question right. At what point would you say where it would break even, do you think?
Yeah, that's a good question. And it's probably almost the opposite environment where we have a slow sell-off and there's no response in terms of volatility, right? So imagine the market sells off, but volatility doesn't increase. Therefore, your options price don't really increase as much either. So that might be the environment where you have a slow, sort of gradual sell-off. And then, you look around, all of a sudden you're 10, 15% down over a few months. If volatility hasn't elevated, then you're collecting less actual dollars as well. Okay,
that makes sense. So it's really if it's a prolonged period of time, I'm assuming, where prices are going lower, but the VIX is back at 15 for a prolonged period of time, that maybe you'll take in less premium.
That's right. Okay. Tends to be a very rare circumstance actually for that to happen.
But that makes me happy actually. It gives me some confidence because we're kind of discussing probably like worst case scenarios. And as a lot of, including myself, a lot of investors who invest in these covered call ETFs, they're extremely dependent, some more than others, of course, some are retirees, some are not, on the distribution. So Global X has a very interesting system. You guys typically have very consistent monthly distributions. For example, some of them you reset them at the beginning of the year, like USCL, QQCL. You reset them higher. Some of them have been decreased. So can you talk to me a little bit about your distribution policy? Do you guys visit this, well, when I say you guys, you and your team, on a month-to-month basis? Or are you reevaluating once a year in December to decide the new distribution rates for the full year? Tell me a little bit about that process.
Yeah, that's a good question. Typically, we review them quarterly. So as you mentioned, at the start of this year, we did change a couple of them around. And we essentially set that for 3 months. And, coming up in April, we'll do that review again. And, really what we're looking for is, has there been any underlying change in the portfolio? Has any dividends been cut or things like that? Typically when we're setting these rates, we want them to be predictable. Like we want to only pay out what we earn, but we want them to be predictable for investors as well. As you say, we know a lot of investors are relying on this income. So we don't want to have it too high and then too low 1 month and then the next month. For example, right now, as we've kind of talked about, we're earning more premiums in this kind of higher volatility environment, but we're not going to increase the distributions this month just because of that. Because that means when times are normal again, we'll have to cut them back down. And so we take sort of a high level view of what we can sustainably earn over the long term and tend to stick to that.
Okay, that's what actually was going to be my next question, because we see some other providers where months of big volatility, they tend to increase their distributions temporarily and then they'll go back to normal. So you guys take more of a high level approach and maybe, for example, let's just say you're taking in more premium, maybe you'll bank a little bit and it'll stay within the NAV. So it's more like consistent.
That's right.
Okay,
Yeah.
that makes sense. So, okay, let's talk about worst case scenario. This is, I would say, an income investor's, including myself's, worst nightmare: distribution reduction. These are not dividend stocks, so we got to remember that a single company, a single stock could cut their dividend by 50%, eliminate it completely. These are not really, there's some dividend income there if the portfolio has dividend stocks, but it's mostly covered call premium. So what would cause you to decide, okay, we need to reduce the distribution by X amount? What would make you do that?
Yeah, so I think first of all, it would be a driver in that underlying asset class. So again, is it a dividend cut, for example? We have some option overlays on fixed income as well. So we've seen recently, particularly Canadian short-term rates come down quite a bit. So we would reduce, in terms of that. In terms of the actual option overlay piece and getting less premium in, that would cause us to cut a distribution. We would have to see a prolonged period of time where, volatility is, very, very low. And I think about times like 2017, 2018, there was extremely low vol in the market and covered call premiums were pretty skinny. If we were trying to eke out more yield than we can generate, and that's affecting our decisions as a portfolio management team, then we would have to consider, potentially cutting it in light of the fact that maybe volatility has overall just reduced. And so that might be something we would do, but it would have to be really a regime change from market conditions.
Okay. And that makes complete sense. How should an investor view a distribution reduction? Because like we talked about, it's different from a single stock cutting their dividend. Maybe they're not making as much profit. We know that this is really reliant on the premium. So if you're a covered call investor, how should you actually think of a distribution decrease? Should it ring alarm bells? Should you start questioning things? What would you say to investors who are worried about that?
Yeah, it's a good question, and it's really about, I think, understanding what caused that distribution decrease. I think being familiar with the provider, I think, makes a lot of sense in their approach to things. If I'm telling you I try to keep my distributions consistent, and then you see me cut one, that would cause you to ask me, right? Well, Chris keeps them consistent. Why is he cutting? So it's about knowing the provider as well, right? If you see some providers, as you say, raise distributions in high vol environments and then vol comes off and it gets cut, you probably shouldn't be surprised by that, right? So I think it's about understanding what's driving that distribution cut or change. Are we in a completely different volatility environment now that's leading to lower premiums? And if that is the case, then you would have to sort of reevaluate your portfolio and make sure you're still getting the income you need.
Yeah, for sure. And from what I've seen, I mean, this is from personal experience, I see that for covered call ETFs, when there is either a distribution increase or a reduction, it's not that big. Is that something that investors could expect with Global X? Like, for example, in January, you guys reduced it on some covered call ETFs, increased it on others, but either way, they weren't massive decreases, massive increases or decreases. Do you see the same thing happening in the future?
Yeah, I think so. And again, we review it quarterly, and we don't really expect from quarter to quarter there being too much changes overall, right? And so if you do see those adjustments, it generally is more minor than anything else. And if there was a larger cut or increase, it would probably be dividend related, not vol related. Because again, we want it to be somewhat predictable, and so we generally know what type of premiums we can be collecting in different market environments, and so we don't want to adjust too much.
Okay, and when you say dividend cut, just to be clear, you mean the stocks inside the portfolio. Like, for example, ENCC is a top 10, 11 or energy companies, and you have the banks one, BKCC with the six banks. So you're saying basically if any one of those big six banks or energy companies reduces or cuts its dividend significantly, you're saying that would have a much bigger impact than, for example, volatility?
Potentially it could. And, you think about a name where if the average portfolio dividend yield is 4%, and all of a sudden one of those banks just cuts their dividend, all of a sudden 4% becomes 3.5%.
Yeah.
50 basis points could be material and therefore could affect the distribution rate. So that feeds into those distribution amounts as well.
Yeah. And Global X, you have a bunch of covered call ETFs. You have some that hold 10 stocks, the 6 banks, but you also have index-based ones. Like you got Russell 2001, of course, S&P 500, NASDAQ 100, TSX 60. You have EQCC, which has a combination of a lot of those. So for the index-based ones, are you guys writing only index options, which are kind of different than writing options on the individual stocks? Do you have the ability to do both? Do you do both? Tell me a little bit about those index-based ones and how, what kind of cover calls you're doing on those.
Yeah, and so for those ones, we generally do stick to the index options. And so again, you mentioned Russell 2000, S&P 500, NASDAQ, TSX 60. Generally broad-based indices with hundreds of underlying in there. So we're not utilizing those single stock options. We are generally writing the index options. Part of the reason for that is there's an extremely low implementation cost for that. So SPX options, NASDAQ, as well as you can imagine, the most liquid options market in the world, and commissions and execution costs very, very low for those strategies, and so we can run it very, very efficiently. Of course, we're always looking at different ways that we can write options and how to extract that volatility, but for now we stick to the index options.
Okay, and in terms of moneyness, which is a big factor, moneyness of the options and time frame or expiration, would you say you normally do out of the money calls? Do you go in every month or every week to see, okay, maybe I could write further out of the money because there's more volatility? I know it's a very active approach. Global X has a very active approach, but maybe you could talk a little bit about concerning the relating to the index ones.
Sure.
How are you guys looking at, okay, let me decide 2% out of the money or 3% out of the money?
Yeah, and let's start with normal market conditions, right?
Right.
Sort of standard markets. We tend to write close to the money options, so not quite at the money, but just a little bit out of the money. That tends to be where you get the most sort of volatility risk premium out of the options market. You can collect the most sort of vol when you're close to the money like that. So we tend to write close to the money, and typically, let's call it about 1 month out. And we mentioned earlier how we stagger our option prices, or we stagger our options. Yeah. So we utilize the weeklies, and we kind of have one every Friday that's going to expire. And then we'll roll that out for another month. And then the next week, same thing happens. And we just keep kind of rolling that out. So it's generally within 30 days. You want to keep it short because that's, again, how you can extract the most premium out of options is by keeping your time frame short.
Okay, so you are using sometimes the weekly options. And so you're not just going in once a month, writing on the whole portfolio or 50% of the portfolio, one big option, and just doing a rinse and repeat. You could stagger them using different legs.
Yep. Yeah, absolutely. And that's part of the active implementation piece. There are covered call indexes out there, and Global X US actually does a lot of that in the US listed market. So the actual strike is defined, when they trade is defined in terms of that option overlay. For us, as you say, it is more active, and we're trying to implement in the best way possible. And so, staggering maturities is part of that.
Okay, I'm just curious, why did you guys decide to take more of an active approach like Global X Canada versus those ones that you mentioned that tend to do a systematic, more rinse and repeat approach? I'm just curious about that.
A lot of it has to do with the regulatory environment in Canada.
Oh, okay.
Active ETFs and non-index tracking ETFs have kind of always been around in Canada, whereas in the US, for the longest time, you'd had to track an index in order to be an ETF. And so that regulatory environment has allowed us to, develop a sort of active approach to option writing that, most ETF providers around the world wouldn't be able to do because they need to track an index, so to speak.
Okay, and we've had a lot of volatility in the market. I'm just curious, let's just stick with the S&P 500, for example. So there's a lot of volatility. What do you guys do in a situation like this? Are you able to write further out of the money? Or do you say, for example, let me write this at the same level and take in a lot more premium, and maybe we'll bank it. We won't increase the distribution for the next month or two. Like, what's the type of stance you guys take when volatility spikes? I hope I'm asking the question in the right way.
It's a good question, and particularly when volatility spikes to this type of level like we're experiencing now. As I mentioned, we're more cautious on when we implement, but also we give ourselves a little bit of room by increasing the moneyness. So, when I say typically in a normal market environment, we're near the money or close to the money.
Yeah.
In this type of environment, we might be a few percentage points above, so 2, 3, 4, 5% out of the money on index level options in order to give ourselves a buffer for some equity bounce back, but also still extract a high amount of premium.
Okay. And like we discussed before, a lot of these ETFs, a lot of the investors are people who are retiring, about to retire, who really need that income supplement. And I know you can never say guaranteed, but can we expect, consistent monthly distributions from these covered call ETFs? Because again, they're covered call premiums, right? That's the majority of the income. And I feel bad saying this, or I feel weird saying it. I believe covered call premiums are like eternal, right? You could always write covered calls no matter what. So you have any comments around that? Am I wrong in saying that? Or I want to give some, some positive to those investors that, especially like now, they're like, oh, is my dividend in trouble, and things like that. So
right.
What would you say around that?
Yeah, I think you're right. Covered calls can always be traded, right? Options can always be sold in the market. The question is, what price are you getting for those options, right? And so that's why we like to stick to those large indices that have very liquid markets behind them. And as a team of portfolio managers, even though we're active in deciding how and when to implement, we also know that we have to implement because, covered call is in the name of the fund. It's the objective of the fund to generate cash flow from the options market. So that's always in our mind that this is a strategy we have to implement on a continuous basis. And in fact, in high volatility times, that's when a lot of the premium is made. And so not to be careful or not to be too cautious or too scared to implement in times of stress because, again, that's the objective of the fund and that's what investors are expecting.
All right. I have a few other questions from actually an Inner Circle member about that a little later. But first, I want to talk about the leveraged ones, right? So you guys have done a really cool thing, in my opinion, where you have a lot of leveraged versions and unleveraged version. Usually the leveraged version will have an L. At the end of the stock symbol, you just change the C to an L and you might have a leveraged version. This is 25% leverage, which is, light, modest leverage, 1.25x. It's not like, 2x, 3x in the US or anything like that. Can you explain how this leverage works? Because this is not like swaps or anything like that. You're actually borrowing the money. So what kind of rates are you guys getting? I'm sure you guys get good discounts because you're a big institution.
Yeah, that's right. We get $100 in the door and we buy $125 worth of securities and we're borrowing in order to get that extra 25. And so, we have prime broker relationships where we can borrow from dealers for that. Typically, it's tied to the Bank of Canada overnight rate plus a small spread. And the securities we hold in the portfolio are used as collateral for that. So, we don't have to worry about margin calls or anything like that because we always have enough equities in the portfolio since we're only borrowing 25%.
That was going to be my next question. People hear borrowing leverage, they think of, I'm going to get margin called. There's a movie called Margin Call, right? So is there a risk or is there a chance that you guys will ever get margin called, or have you selected that 25% where it'll never be a problem?
Yeah, because it's 25%, we'll always have enough, equities in the portfolio to satisfy that collateral requirement. I'd say the risk for investors is that you have leveraged exposure, so you have more downside risk should markets sell off, like we have seen. A leveraged fund will sell off a little bit more than that, so you just want to make sure you're able to take on that kind of risk.
Okay, yeah, it's an interesting question I get all the time. What if Global X gets a margin call? You know what I mean? So it's good that you answered that. So I want to take a few questions now from some of my longtime watchers, and they're part of the PII Inner Circle. And this is from Jacques. He's a longtime watcher. He's a retiree. He's retired. And his question is kind of similar to something I get all the time. And this is where I love talking to people who actually know the options market in and out. Is it difficult to sell call options when there's a big down market, if there's a lot of volatility? And that's the first part of the question. Second part is, if there's more and more and more of these covered call ETFs coming out, is the covered call options market getting too saturated? I don't know if that makes sense, but too much competition. There's too many people selling the calls, not enough people buying them. So what would you say to Jacques?
Yeah, great questions. I'll take the first part first. So
Yeah,
when the market's down, typically there's actually more choice in terms of trading and implementing.
interesting.
Dealers tend to make most of their money in volatile times. They want things to move so that people are trading, right? And so when markets move, trades happen. And so dealers are generally willing to facilitate any trade. Again, you do have to pay attention to the bid-ask spread a little bit because spreads will widen out. So as
Hmm.
long as you're comfortable with the pricing you're getting for the exposure, you shouldn't be able to find or shouldn't have trouble finding a trading partner in that market. In terms of the second part of the question, it is a good question because I think it is possible for too much to line up in one side of a trade, right? And this is in any market, not
Hmm.
just covered calls. When too much money flows to one side of a trade, pricing tends to suffer a little bit. Now, in terms of covered calls, it would be very hard to do. Perhaps on a Canadian sector that's a little bit more illiquid, if you had three,
Right.
four, five funds, selling vol there, that would impact prices for sure. But again, going back to the big indices, S&P, NASDAQ, Russell, there's so much money following these markets that it's
Right.
very hard to get too much on one side of the trade. And there's really market dynamics are going to dictate pricing much more than how many people are selling options.
Okay. Would you say that the options market in general, I know the US is the biggest in the world, the S&P 500, NASDAQ 100. What about on the Canadian side? You mentioned that maybe it could be a little bit not as liquid. Are you seeing that increase? Are you seeing that stay relatively the same? What's your thoughts on the Canadian options market? I'm just curious about that whole environment now.
Yeah, and it is quite different than the US, of
Hmm.
course, the US being as big as it is. I'd say the Canadian market has a decent amount of liquidity for its size. And particularly for us as institutional investors, we have good relationships with all the dealers on the street that are always willing to facilitate flow, regardless of what the screen looks like, right? So a lot of, I think, individual investors might look at the options market and say, wow, prices are so wide, there's no volume, it looks very hard. And for a retail investor,
Right.
it could be. But for an institutional investor, again, with those dealer relationships, we're able to find that liquidity and get good execution on our prices. The options market is very similar to the ETF market in that liquidity and pricing is driven by the liquidity of the underlying, right? And so when I think about the big six banks, very liquid
Yeah.
names, ENCC, top energy names, very liquid. If you went into another sector that was maybe smaller and, like utilities, for example, smaller companies, they don't trade as much.
Hmm.
There's only so much call selling you can do in that sector before your pricing would start to get potentially impacted through lower option premiums. And I think, that's really a great thing of the market is it's a self-correcting thing, right? If too much money goes one way, yields come down, it becomes less attractive, money goes elsewhere,
Yeah.
then those yields potentially come back up, right? So it's all market dynamics working together.
Okay. Another question I get often, maybe you get it, I don't know. Who's buying all these calls, right? With more and more cover call ETFs coming out, everyone's like, well, who's buying all these calls that all these fund managers are writing on a lot of the same stocks, like the six banks or the S&P or things like that.
Yeah.
So would you say, maybe we could stick to Canada because in the US it's massive, but
Yeah.
the smaller markets, who's actually buying all these calls?
Yeah, another good question. Like who's buying this stuff?
Is it retail? Is it
Um,
institutions?
and for us and for the size we do and for most covered call ETFs, it's really the institutions, the dealers that are going to be buying these options. And when I say dealers, I mean the capital markets desks across, the major Canadian banks, some of the smaller players as
Mhm.
well. Essentially a dealer can take one side of the option trade and then hedge their side of the portfolio. So they facilitated a trade with us and then can offload their risk so they don't have any risk on their books either. And so I think options are actually a great scenario where both sides of a trade can win. Most stock trades is a zero-sum game, right? Whoever paid the right price wins and whoever didn't loses.
That's true.
In an options market, I can sell to a dealer, I can collect my premium, and so I've quote unquote won. And that dealer can unload their risk and keep that premium, and they've won as well. So it's a great market, and again, it's intent on or needed to have these sort of big institutions and these dealers help us with that liquidity. But being connected with all of them certainly helps us.
I like that. Win-win, right? Yeah. So, when you're selling or when you're buying a call option, it could be for two purposes, because you're bullish on a stock. You think the stock's going to go up, so you could leverage it or whatever it is using options. But it could also be used to mitigate, to hedge, right? As well. So like you said, there's always two sides to the coin, and the trade could be done. So another question I got, still from Jacques, and I've been getting this more and more. You've been hearing this in the news and on the financial programs where the S&P 500, the US market, NASDAQ 100 has been a lot under pressure, especially lately. So you kind of seen Europe ETFs or emerging markets ETFs kind of get a lot of inflows and maybe a little bit more outflows in the US market. Have you seen that at all? Have you seen that behavior, capital getting out of the US and going into things like Europe or international? Just curious if.
In general, we have actually, and that's not just in our covered call suite, but across the board. A little bit less into US, or some coming out of US, Canada as well, and EFI markets becoming a lot more popular with investors. I think we were at a point where valuations were very, very different between the two countries. And this is a reason for investors to maybe make that trade and trade away from the higher valued US market. In the covered call space, we've seen EACC, that's our EFI fund, CNCC and EMCC, our emerging markets, also see a little bit more flow than they usually have. Again, I think it's because just diversification and allocation away from US.
Yeah, that's what I like about the Global X lineup. You guys have the S&P, the NASDAQ, the Russell, but you have the TSX 60 when it comes to the Canadian market, and you have the Far East and Europe one, which is EACC, the ACL as well, the leverage one, and you have the emerging markets. You literally have all the indexes covered, and then you even have one that has all of those put together. Cover call, non-cover call, leverage cover call. I mean, you have all the options, which is pretty cool, which is pretty, gives investors a lot of choice. And I tell people all the time, you can mix and match them too. You don't have to be fully covered call. You know what I mean? So it's really cool that you guys have expanded the lineup to and really focus on those indexes a lot.
Yeah, I'm glad you say that, because that's what I tell investors too. Not everyone needs a 10% distribution, for example. So you can blend these things together in various amounts and create your own sort of distribution yield.
All right. And these are probably questions you can't really answer that much, because I know you can't talk about future ideas, future products, but I'll try anyway. Something that's been very popular on the US market when it comes to cover calls are weekly distributions. Now, I know Global X is actually about to launch their Bitcoin cover call ETFs, which I believe has bi-weekly distributions. So what do you think about weekly distributions? Is it something you guys are looking at? Have you had a lot of requests for weekly dividends, weekly distributions?
Yeah, I think we did see the potential for some innovation in this space, right? And it's really just really a product feature more than anything else, is when do you distribute, right?
Right.
And so, as you said, we did come out with our latest prospectus. I believe the term in the prospectus is semi-monthly.
Semi-monthly.
Which means twice a month.
Right.
Is our goal for those Bitcoin distributions. And I think, we wanted to start there. We thought about, kind of like mimicking a paycheck. You get it twice a month. That helps out with your cash flow. And so we'll see how that does. I can't say we have any plans for weekly distributions at this point, but I think this is a good first step towards that. We'll see how that success looks and see if there's anything further we can do.
If it's super popular, are you able to maybe, for your whole suite of cover call ETFs, maybe switch to semi-monthly? Would that be something that possible down the line?
Yeah, I don't think we need to launch something new. We could change anything existing to whatever frequency we wanted to.
Okay, perfect. So yeah, the second thing that's really popular on the US side that we don't really have yet on the Canadian side is the 0 DT options. These are options that expire within 1 day, right? 0 days to expiry. So have you guys looked into these options? I've heard that they're a bit more costly to implement. And I believe that tell me what you think about it. Well, let's start with the first question. What do you think of 0 DT options in general?
Well, I think it's a great innovation for the market. When they first launched, people were asking, well, why do we need 1 day options? Fast forward to today, and it's almost 50% of the options market in terms of volume. It's over 40% of the S&P market is 0 day or 1 day options. I think investors and market participants have found different uses for this. It's not just people taking a punt on a one-day return. It's used for risk management. It's used by dealers for hedging into the close, used for various purposes. So I think what gives us confidence is in potentially using them in an ETF is the amount of volume and flow and activity that we've seen pick up there. And so I think it's very well supported from a market structure point of view. Now it's up to us to do our homework and see how can we fit this into an ETF. Is there a systematic strategy we can utilize? What are the different ways we can use this? So we're looking at that space. Our Korean partners over in Korea have launched the zero DTE option ETF. And so we're collaborating with them as well to see how that goes, understanding liquidity and all those sort of things. So doing our homework is what I'll say there.
Super interesting. Really appreciate it. Yeah, that's it for the questions. So you spent a lot of time with us here. I really appreciate it. And hopefully we'll do this again very soon.
Sounds great.
All right.
Awesome. Thank you.
Thanks for watching, everyone. Really appreciate it. Hope you enjoyed it. Pretty fun for me. If ever I missed anything, there's a question or you have a burning question you want to ask Chris, make sure to leave it in the comment section below. Don't forget to hit that like button. I would really appreciate it. And see you next time.